The Fed just pumped $74 billion into the U.S. banking system after it showed unusual signs of stress to end the year. Put volume is spiking, the move with silver is getting even crazier, and 96% of the S&P 500 fell on Wednesday. Today, we cover what all of these developments mean, where the action is at, and what normally happens next. Let's have a great start to 2026.
Something very unusual just happened beneath the surface of the U.S. financial system. In a single day, the Federal Reserve injected $74 billion into the banking system. This is the largest liquidity operation since COVID and even surpasses the peak from the dot-com bubble. This isn't just noise, this is a real signal. On Wednesday, banks were short on liquidity, and this pretty much forced the Federal Reserve to pump that $74 billion into the system. And a lot of traders out there are a bit confused on what this really means. Essentially what happens is the Fed lends money to banks when they need it. These loans are temporary and usually only last one day, and in some cases up to even 1 week. It's common to see liquidity tighten for the banks around the end of the month and the end of the year. They're essentially trying to make their balance sheets look safer, and the Feds step in as a backstop, allowing banks to temporarily swap treasuries for cash so markets keep functioning smoothly. This really, at the end of the day, in simple terms, shows that banks are under stress right now, and the Federal Reserve has to step in with their SRF to essentially keep the system going.
And what's so unusual about this is the magnitude of this dollar amount. $74 billion is the largest we've seen since COVID. And like you said, it even surpasses the peak from the dot-com bubble. So it means something. It doesn't mean the market is going to crash into oblivion, but it does say something. And Tom, when we look at the market lately, it definitely has been weakening, and we're starting to see that selling pressure pick up a bit. On Wednesday, something pretty rare happened where there was only one stock in the NASDAQ 100 that finished green, ticker symbol ALNY, and it was barely green, as we can see, and 96% of the S&P 500 fell in the red. But surprisingly, this might actually be a good thing. As we can see from these stats here, whenever the S&P 500 had fewer than 20 stocks go up, basically, the market normally rises from that. It actually marked short-term bottoms. So maybe this isn't a bad thing, Tom.
Definitely. Sometimes this happens. If we see an overreaction in one direction or the other, you could see a pop back in the shorter term. These stats are very telling, though. Whenever you see the S&P 500 get that weak with less than 20 stocks going green, whenever you get to 3 days to 1 week later, the market's green 100% of the time, and even 1 and 2 months later, we see the market green again. Right now, we're heading into the end of the Santa rally. The Santa rally's officially going to be ending Monday, January 5th, and that'll be the second day on this reading. So will the Santa rally end up green? Time will tell. If the market keeps trending the way it has been the past few trading days, though, we might end up with a red Santa rally. But these stats are pretty promising here. And Mike, there's been a lot of emphasis on put buying lately, and it makes sense, right? Whenever you have days like we did on Wednesday with the SPY dropping down 0.74% and that good intraday downside action, it makes sense that traders are flocking into puts. We actually saw the put call ratio exceed 1.12, and whenever this has happened, again, it pointed to pretty positive stats once you get to 1 to 2 weeks later. In the shorter term here, there does seem to be some volatility, pretty much with stocks going green 45%, 65%, and 65% 1 to 3 days later.
Yeah, and the last time we saw the put-to-call ratio get as high as it is now was during that Liberation Day crash back in April. So very interesting data here. It definitely sticks out where, yes, in the short term, it can bring a little bit of chop, but in a broader sense, it is a good sign. So I think the best way to interpret this is that even though we have some negative developments in the market right now, a lot of what history is pointing to is more bullishness and uptrend the further you look out. So that's good. And as we head into 2026, everyone wants to know how the market is going to do this year. And at least historically speaking, the stock market does very well in a president's second term midterm year. So we can see with the chart all the way at the top, this will be Trump's second midterm year. And with all of the instances in the past, the market does pretty well.
It definitely does. I mean, 1 month later in 2014 with Obama, the market did drop a little bit there, down 3.5%. But besides that one red reading, every single month, and especially 1 year later, went green. And whenever we look at these 6 month and 1 year later categories, I'm pretty impressed with these numbers. 6 months later, the market's green 100% of the time with average returns of 11%. And then 1 year later, of course, that almost doubles, being 20.8%. So I'm pretty happy with that. If we go into 2026 and we continue to see the market perform in a good way, kind of like that upper chart might continue to show, we'll be at all-time highs pretty quickly, and we might see some good price action. It does look like, though, Mike, that at the very beginning of the year there might be a little bit of chop.
Yeah, and I think that's worth observing. It looks like this is more of like a broader pattern as expected. But like when we look closer at the market right now, it has been a very disappointing Santa trap this year. And this sell-off is starting to pick up a little bit, especially like from Wednesday. When we look at the market right now, what levels are on your radar and what are you seeing on the charts?
Yeah, the SPY peaked out at 691.65, and to the low of day Wednesday, that's essentially like a 1.4% pullback that the SPY has had here. Again, this is a very negative Santa rally going on so far, and there were a few levels that we highlighted last week to watch for, specifically 683. This is going to be one of the bigger zones that I watch for the next couple trading days now as resistance, since the SPY did fall below there on Wednesday. And then there is a good support coming up around 681.50. You can see on the left side of your screen, there's been a lot of price action and reactions close to that 681.50 zone recently. That was essentially the low of the day on Wednesday. So if we start to see the SPY fall through that, 680 and below will be on the radar in a pretty awesome way. I think dropping under 680 would be a pretty bearish sign. I will be watching for that recent low to come into play closer to 671.20 if we do break under there. And I also like supports closer to 675, where we had some really good reactions over the past couple weeks. So those are a few levels to watch for if the SPY does fall down. Of course, if the SPY starts rising, I would love to see 686 rebreak. We saw a really good intraday rejection there on Wednesday, and that would be a very bullish level. If we start to break that, I would not be surprised if the SPY tried to test highs within the next couple days following that break.
Yeah, like we're close to all-time highs in a general sense, and we do have a lot of good bullish stats, pointing to the upside, especially like over like the next couple of weeks or so, as we've just showcased. But another thing worth keeping in mind is that the market has been pretty choppy and trap-like in the short term, and a lot of that had to do with the holidays. Basically, we normally only see 45 to 70% of like normal volume between December 23rd and January 1st. So it's going to be nice to get out of this like holiday mode, because we should start to see liquidity return and, start to see some like bigger, better moves come into play. So that is exciting from a trading standpoint. And as we know, like silver has been like one of the hottest areas of the market lately, and it is getting the smackdown, Tom. What's going on here?
It definitely is. Silver was down 6.6% again here on Wednesday. We've seen two pretty bad drops with silver in the shorter term, and it's really, at least SLV, is having a lot of trouble holding $70. We can see multiple rejections very close to here, whether you look at that slight pop above up to 72, or you look at the one closer to 71 from Wednesday or Tuesday into Wednesday. We are seeing that chop and the smackdown start to come in. There is a very large support here around 63.75 on SLV that will be on the radar. There is like essentially a triple bottom here. So if that starts to give out, look for even more selling pressure. But I know, Mike, a lot of traders have been looking at SLV to the downside because the CME has been raising their margin requirements, and they did this yet again on Wednesday. So that's a pretty negative thing. I guess technically it was Tuesday, but the main effects of this ended up coming through on Wednesday. And, we can see in the past that when they've done this, we saw silver drop pretty much 30% within just a couple of weeks. And heading into that year, silver fell down 47% in total. So be on the lookout for silver in the short term. When they did this in 2011, you can see that initially there was some volatility and a double top formed. We're actually seeing that very same thing happen. If we go to silver in the short term, we go to a daily chart, you can see that, again, we're seeing that volatility play out, and then there's a crucial resistance overhead that silver is failing to break past. Silver itself, it's closer to $80. If we look at SLV, keep your eyes on 70.
Yeah, like a lot of people who are following silver make the argument that, there's a lot of differences between right now and 2011, and that's completely true. But at the end of the day, when the CME increases margin requirements, it has a serious impact on just the underlying trading that happens with silver, because when the margin requirements increase, it forces liquidation. You need more money to come up and trade with the same amount of silver contracts, and this just reduces the amount of buying pressure that can continue to fuel this rally. And while every single year and setup and situation is unique, these patterns between 2011 and what's happening now do look eerily similar.
They definitely do. And, we are seeing some active selling pressure start to hit. And, if we look at the silver chart here on the way up, there has been some periods where we have seen, some bearishness come into play, right? But I would say in the shorter term here, this is getting pretty volatile, right? We're seeing some pretty big drops along with huge pumps coming in very quickly. So the volatility is picking up. And it almost seems like, Mike, that I don't even want to say this, but SLV is almost becoming meme-like right now. It's blowing up, kind of like GameStop, AMC, and others.
Yeah, it definitely has that hype to it, and it had a great year, but it's just at what point does the rally just collapse on itself? We will see. Looking at the rest of this week, though, the lineup is pretty clear. There aren't any major earnings set to come out, and the economic schedule is all clear as well. So that's nice to see. So let's jump right into some setups and predictions. Stock that is on my radar is TSM, and it's to the downside. We have been seeing more weakening lately, just with tech stocks in general and the market. TSM has a ton of resistance between this $310 to $315 range, and I think it's presenting a good risk reward playing it to the downside for the next 2 weeks or so. I would like to see a rejection off of this resistance level and possibly even a return back to that 265 area, maybe lower, depending on how the momentum unfolds. Either way, this one will be on my radar.
Yeah, it seems like there's a major range here on TSM, and it's been rejecting off the top of the range and falling pretty close to the bottom of the range each time. So I will be watching it closely. It's been a pretty consistent range thus far. With my first play, I'm looking at Tesla to the downside here. Tesla has been rejecting in a major way. They made a new all-time high, got very close to $500, but as we know, that $500 level is held up as major resistance. And what I'm looking for is a possible downside continuation, with also the possibility of buying up the dip once we do get a confirmation back up. I thought that the close on Wednesday was very negative, just under 450, and if we continue to see Tesla hold under 450, I will be watching it to the downside. If we go to the Bookmap here, there are buyers stacked up at 445 and 440. I really like 440 down there. There's around 52,000 shares. That's a nice whole dollar level. There was a few more buyers that stacked up at 445 around the end of the day Wednesday, but I think 440 could be a really good target. There's a buy wall on Bookmap, and it also lines up. If we go to a Tesla hourly chart here, 440 is a pretty big area of support where Tesla had been bouncing multiple times lately, at least very close to there. So I will be watching this level for a possible buy the dip opportunity, but I also think that there's more scalping opportunities to the downside as well, while Tesla continues to see the selling pressure unfold.
Yeah, it's an in-play stock. It'll be on my radar as well. I know they had that negative analyst coverage related to their deliveries data, which has been making the stock a little bit weaker than normal in the short term. So we shall see. Another group of stocks that is on my radar is the energy sector. So tickers like OXY, XOM, EXE, and others. We have been seeing energy prices rise, especially due to all of the geopolitical geopolitical conflicts that we have going on between the United States, Russia, and even China. Either way, we have been seeing good movement out of these energy stocks. They pulled back a little bit on Wednesday, but they're still on my bullish radar in a broader sense.
Yeah, exactly. Like there's always going to be some downside mixed in here, but we are seeing energy play or the energy sector come back into play in a major way. There's always going to be red days mixed in on the way up, but some of these opportunities like Oxy in the short term have been fantastic. So I will watch them to the upside as well if we start seeing some more buying pressure come through. But with my next play, I'm looking at a growth stock to the downside, and this is going to be D-Wave Quantum. D-Wave Quantum has actually been testing a shorter term trend. You can see on the longer term chart here, they've also been fairly weak, especially since peaking out in October. In the ultra short term, again, they're testing this trend line and they're in a bit of a downside wedge. So what I'm watching for is the upper resistance here to hold around 27.45 to 27.50. If that continues to hold, I will be watching for QBTS to fall under its short-term trend line. It closed right at that trend line on Friday and is barely under it in after hours. I think if you want to see a good confirmation, confirm that this stock falls below $26, and if we see that drop-off come into play, trade it to the downside as it falls out of that wedge. I think it could make for a great, quicker scalping opportunity. I don't think it's anything you have to hold all day long, but catching that first initial drop will be important. So keep QBTS on the radar as long as this structure continues to hold up.
Sounds good. All right, well, let's jump right into today's momentum plays. With the first one, we have Traeger, ticker symbol COOK, to the upside.
So this stock is high risk, high reward. It's only $1.08, but it has been starting to move a lot more recently. If it breaks above 110, then watch it to the upside.
With the next one, we have Nano Nuclear Energy, ticker symbol NNE, to the downside.
My gosh, we've called this one out now 3 videos in a row, and it just continues to sell off. So keep riding the wave until it comes to an end. If we see it fall under the low of day at 23.60, then watch it down once again.
And then with the last one, we have Micron, ticker symbol MU, to the downside.
Micron had been on fire lately, but hey, on Wednesday, it started pulling back, and there's actually a really good double bottom close to 284. So if we see 284 give out, watch it to the downside.
All right, so we have these 3 stocks on the radar for potential continuations if and only if they break through the levels listed. These stocks are volatile, so you have to protect yourself. Focus on making smart, disciplined, long-term oriented trading decisions. Check out the Key Lessons channel for a bunch of great free information in the StockedUp Discord. But besides that, Tom, let's jump right into today's $608,000 big money trade, and we are looking at ticker symbol JD. The trader here bought the 25 strike call options that expire on February 20th of 2026. Again, this is a $608,000 trade. JD is a Chinese e-commerce company, and it is actually the largest Chinese retailer by revenue. JD stock has sold off a little bit in the short term. Its implied volatility is at its lowest level since COVID, which means these options are priced relatively cheaply. These call options are also deep in the money and have around 51 days of time to them, so the trader is positioning themselves to benefit off of an uptrend in a short to medium term sense. As we know, Chinese stocks move differently than U.S. stocks, and I don't think that's a bad thing at all, especially in this market environment. I think it's actually a positive trait to have, at least for some positions. I think this is a very interesting setup. It's not the biggest or craziest trade we've ever seen, but it definitely does stand out.
It really does, especially as there's been a lot more focus on China in the short term with all of their military actions with Taiwan lately. So I will be watching this very closely. JD's also bouncing off of a big support. It recently double bottomed around 28 to 28.25, and now it's actually getting very close to there again. If we start to see it bounce back to the upside, it could create a really good buy the dip opportunity here. As you mentioned, JD had pulled back a lot recently, and from its recent peak to where it is now, at least at the recent bottom, it fell down by like 23%. That is quite the sell-off there within just a few months. So I'll be watching for it to possibly pop back up. We haven't been seeing too many negative negative headlines with China lately besides the Taiwan news. One of the biggest fears I have is, once we do start to see more tariff headlines come into play, but again, maybe it'll end up being positive and actually help these stocks. But I feel like the support range it's getting to is also going to be a very important factor. If that starts to break down, of course, you don't have to keep bag holding.
Exactly. So either way, let's keep it close on watch. If you are new to the channel, welcome, and consider obliterating that subscribe button. For every trading day, we post a new video covering the most important information to know, hot stocks to keep on your radar, upcoming events and earnings to pay attention to, historical stats, and much more. When you subscribe, you'll get our videos recommended to you more often, so definitely consider doing that. We have a lot of exciting things planned for 2026, and we also want to give a giant shout out to today's member of the day, Benny, in the Stocked Up Discord. Huge shout out to you and huge congratulations on a great 2025. Thank you for being a great member of the Stocked Up community. We're happy to have you, and keep on rolling. Thank you all so much for watching, and let's make 2026 a great one.